Welcome to the Deep Dive, where we slice through the static to get you truly well-informed. Today, we're diving headfirst into the colossal world of Tyson Foods. I mean, this company is so massive, its products, Jimmy Dean sausages, ballpark hot dogs, tons of chicken and beef, they're probably in your fridge right now. And they've got this really ambitious mission statement: we feed the world like family.
That's quite a statement, isn't it? Sets a high bar.
It really does. So for this deep dive, we're working from Tyson Foods' latest financials, specifically their Form 10Q report for the quarter ending June 28th, 2025, and their recent earnings press release. Our mission today is pretty straightforward: unpack the key results, the operational stuff, and, well, the significant challenges this food giant is dealing with. We want to help you quickly get a handle on a really critical player in the food industry.
Exactly. And while, headlines might just grab the top-line sales numbers, we're going to try and connect the dots a bit more. We'll highlight what's actually fascinating in the details. Things like a pretty substantial financial hit in their beef segment, some major ongoing legal fights, and some big strategic shifts they're making that are really reshaping how they operate.
Okay, sounds good. Let's unpack those headline numbers for you first then.
Yeah.
For Q3 of fiscal 2025, Tyson reported sales just shy of $13.9 billion. That's up a solid 4% from last year. But here's where it gets, really interesting. Their GAAP operating income, that's the standard accounting measure, right? It was actually down.
Yeah.
Down 24% to $260 million. It feels a bit weird, doesn't it? Sales climbing, but profit taking such a hit.
It does, yeah. And that immediately raises the question, well, how can sales be up, but operating income drops so much? The core reason for that sharp drop this quarter was a massive $343 million goodwill impairment charge. It was fully recognized in their beef segment.
Okay. Goodwill impairment.
Yeah, we'll dig into the why of that in a moment, but what's crucial to understand is that on an adjusted basis...
Right, where they strip out those big, maybe one-off items.
Exactly. Things like this impairment or maybe major legal costs. On that adjusted basis, their operating income actually showed a modest gain. It was up 3% to $505 million. So that adjusted figure often gives you a clearer picture of the underlying operational health.
Okay, that distinction makes a lot of sense, especially with those kinds of charges. So if that's the quarterly snapshot, what about the longer view? What does the 9-month picture tell us about the trends for fiscal 2025?
Right. So over the full 9 months, sales went past $40.5 billion. That's up just over 2%. Now, it's worth noting here that certain legal expenses, they call them legal contingency accruals, basically money set aside for expected legal stuff, those actually reduced their reported income by $343 million. So while sales saw modest growth, the real story for the 9 months is probably profitability. GAAP operating income was up a decent 6% to $940 million. But again, when we look at the adjusted figures, stripping out those one-offs, adjusted operating income really jumped. It was up nearly 30% to over $1.6 billion.
Wow, quite a difference.
Yeah, and the strong operational performance, it also translated into a pretty significant boost in adjusted earnings per share, up over a third to almost $3. That's even while the standard GAAP EPS saw a slight dip.
Fascinating. So, okay, with that picture of profitability and the impact of those charges, let's talk about cash, the lifeblood, right? Cash flow, overall financial health. How agile is Tyson right now?
Well, despite the volatility, they do seem to maintain a pretty strong financial position. Cash from operations for the 9 months was $1.62 billion. That is down a bit from last year, though.
Okay.
And similarly, free cash flow, that's your operating cash minus capital spending, was $929 million. Also a bit down. However, their liquidity looks quite impressive. They were holding $4.0 billion as of June 28th.
$4 billion, okay.
Yeah, and that includes a new $2.5 billion revolving credit facility they set up back in April. Think of that like a huge corporate credit card, basically. Gives them flexible access to funds if they need it, really boosts their financial flexibility.
Right.
And maybe crucially, they actually managed to reduce their total debt by over $700 million during these 9 months.
That shows some good financial discipline, especially in a tricky market.
Oh.
Okay, now Tyson operates across, 4 main segments: beef, pork, chicken, and prepared foods. To really get what these numbers mean, I guess we need to peel back the layers and see how each protein segment is doing, because you hinted it's a bit of a mixed bag.
Oh, definitely a mixed bag. It's a tale of stark contrast, really. Let's kick off with beef. Sales here were actually up significantly in Q3. That was driven by a big 10% average price increase.
Okay.
But interestingly, the volume, the amount they sold, was down over 3%.
Yeah.
And while this segment recorded a massive operating loss, almost $500 million just in Q3. Yeah, and that ballooned to an $816 million loss for the 9 months. So this segment was really the main reason for the company's overall GAAP operating income decline.
So that $343 million goodwill impairment charge you mentioned.
Yep, that was fully recognized right here in beef in Q3. And this impairment, it came after the segment was already flagged as being at high risk. It really reveals a kind of a critical vulnerability maybe in their long-term planning for beef. It's a stark reminder of how volatile these commodity markets can be, even for a giant like Tyson.
Right. And the why behind it.
The why is crucial. It's basically down to a lower than expected supply of market-ready cattle that drove up their costs. And it seems the recovery for herd rebuilding is taking longer than they thought. And on top of the impairment, the beef segment's 9-month results were also hit by a $93 million legal contingency accrual and about $48 million in network optimization charges. So, yeah, a tough spot for beef.
Quite the uphill battle there.
Yeah.
Okay, how did the pork segment fare then? Was it any better?
A little better, maybe. Pork saw sales up slightly in Q3, but still down for the 9 months overall. Volume was up in Q3, but like beef, down for the 9 months. That was partly due to a plant closure.
Okay.
Operationally, Q3 income was $36 million. Now that's a welcome turnaround from a $62 million loss in the same quarter last year, so progress there.
That's something.
It is. But for the 9 months overall, they're still showing an operating loss of $100 million. And it's also important to note this segment got hit with a $250 million legal contingency accrual for the 9 months as well.
Okay, so still some definite headwinds for pork. But if we're looking for a bright spot, I'm guessing we should look at chicken.
Absolutely. The chicken segment is the standout performer right now. Sales are up, volume is up, mostly thanks to increased domestic production.
Good news there.
Yeah, and operating income really jumped, $367 million in Q3 and an impressive $980 million for the 9 months.
What's driving that?
It seems to be a combination of things. Strong operational execution, definitely. Improved volumes. But crucially, reduced feed ingredient costs.
Feed costs. Always huge for chicken.
Always. We're talking about a $20 million decrease in Q3 alone and a really substantial $285 million decrease over the 9 months. So this segment's stellar performance, while helped by good operations, is also getting a big boost from those falling feed costs. It kind of highlights the inherent risk and opportunity in their diverse portfolio, right?
Right.
Highly susceptible to commodity prices.
Makes sense. Any other minor impacts there?
Yeah, some small things, minor charges from discontinuing some brands, plant closures, but the overall trend in chicken is very positive.
Yeah, good. And then the last big one, prepared foods. This holds a lot of those household names, right? Jimmy Dean, Hillshire Farm, Ballpark.
Exactly. And this segment is a real margin leader for them. It hit the highest operating margin, an impressive 12.0% in Q3.
12%. Wow.
Yeah. Sales were up, mostly because they successfully passed on higher raw material costs to consumers.
But volume?
Volume did decrease, actually, and the company puts that down to a challenging consumer environment.
So maybe consumers are pulling back a bit on those kinds of items.
Sounds like it, perhaps on some of the higher-priced convenience stuff. This segment also got a benefit from their network optimization plan, about $56 million in net income in Q3, $31 million over the 9 months.
Interesting. And just quickly, anything on the international other segment?
Yeah, that segment also showed better operating income. It was largely due to a couple of external things, really. $14 million in insurance money from a fire at a facility in the Netherlands.
Oh, right.
And another $6 million in compensation, basically, from relocating a plant in China. So a bit of a boost from outside factors there.
Okay. So given these really different stories coming out of each protein segment, beef struggling, chicken flying, it's clear Tyson isn't just sitting back. You mentioned this network optimization plan. What exactly are they doing there?
Right. So they kicked off this network optimization plan back in Q1 of fiscal 2025. The goal basically is to streamline their global operations and logistics, make things more efficient. They're taking some pretty significant actions, writing off assets, severance packages, ending contracts and leases.
Sounds expensive.
It can be, but what's fascinating here is they also generated significant gains from selling off some cold storage facilities, over $100 million just in Q3 and $252 million in proceeds over the 9 months.
Selling them off. But don't they need cold storage?
Well, interestingly, they're then leasing back those same facilities for 1 to 3 years and entering into long-term service agreements for them, too.
Huh. So it's a financial move as much as operational.
It seems like it, yeah. Frees up capital, perhaps. The stated goal, though, is to reduce network complexity, make inventory flow better, simplify processes, and ultimately cut operating expenses. It's definitely a multi-year effort, and they've signaled we should probably expect more charges related to this plan down the road. It feels like their proactive response to the market pressures, especially in beef and pork.
And this isn't totally out of the blue for them, is it? It's kind of connects to previous moves, like closing plants.
That's exactly right. You might remember they approved closing 6 chicken facilities back in fiscal 2023, and then some beef and pork plants in fiscal 2024. These actions were all framed as, optimizing how they use their assets, shifting production to more efficient locations. So yeah, it's an ongoing effort to streamline.
Okay, so that covers the operational shifts.
Right.
Now, let's transition to something else significant and, frankly, ongoing for Tyson. This complex web of legal proceedings. They seem to be involved in multiple antitrust and wage litigations across different segments.
Yeah, it's quite extensive.
Yeah.
And just to be clear up front, our role here is simply to report what's in their filings, right? We're not taking sides or endorsing any views, just conveying what the documents say.
Absolutely. Impartial reporting.
Right. But the sheer volume and the potential financial burden of these legal battles covering antitrust, wage disputes, environmental issues, it really taints a picture. For a company Tyson's size, managing this kind of systemic legal risk seems almost as critical as managing their supply chain. It's clearly a significant ongoing drain on resources and, management attention.
So can you break down the main categories for us?
Sure. First, on the antitrust front, they're facing lawsuits across beef, pork, and chicken, basically alleging price manipulation or conspiracy. For instance, in the broiler, that's chicken antitrust civil litigation, Tyson has already settled class claims totaling over $220 million.
Okay.
Now, the company is careful to state that settling doesn't mean they admit liability. They frame it as avoiding uncertainty, risk, expense, and distraction.
Standard legal language.
Pretty much. What's interesting here, though, is they received conditional leniency from the Department of Justice back in 2021. That was for self-reported issues. It means no prosecution or criminal fines as long as they keep cooperating.
But it's not entirely over.
No, they're still dealing with individual plaintiffs who opted out of the class action settlements. There is actually a trial scheduled for, I think, April 2027 on that.
Wow. Okay. And similar fights in pork and beef.
Exactly. In the pork antitrust litigation, allegations go back to 2009. Tyson added $250 million to their legal contingency accrual just in Q2 of this fiscal year.
$250 million just for that.
Yeah. They have reached an agreement in principle to settle with some direct purchase plaintiffs for $50 million. But the first trial is expected in Q1 of fiscal 2026. So still ongoing. And then for beef antitrust alleging price manipulation since 2015, they set aside $93 million in Q2 FY25. The fact discovery phase, where they gather evidence, just ended in April 2025.
Okay, so antitrust is a big piece. What about the wage litigations?
Right. Beyond antitrust, they also faced wage rate litigations, both in poultry and fresh meats. The allegations were about depressing worker wages. Tyson reached agreements to settle both.
Right.
The poultry case for about $115.5 million and the fresh meats case for $72.5 million.
And again, no admission of liability.
Same line. Yeah. Settling to avoid uncertainty, risk, expense, and distraction.
That's quite a list of settlements and accruals. Are there any other major legal things hanging out there?
Yes, a few other complex ones to mention briefly. There's a very long-running labor claim in the Philippines. It has a complicated history, a huge award initially, then it got vacated, now it's at their Supreme Court, so still unresolved. Then there's an environmental complaint in Oklahoma about the Illinois River watershed. That went through a long non-jury trial. The ruling actually went in favor of Oklahoma back in 2023. Now it's in the remedies phase, figuring out what needs to be done with submissions due pretty soon by August 11th, 2025.
Okay.
And finally, they also mention COVID-19 claims from team members, but they state no liability has been recorded for those. So, yeah, it's a truly complex legal landscape they're navigating.
Definitely sounds like it. Okay, so despite all those challenges, particularly in beef and these ongoing expensive legal battles you mentioned earlier, they still maintain a strong financial position. And they have an outlook for the rest of fiscal 2025. How are they positioning themselves financially?
Well, as we said, their current liquidity is $4.0 billion. That's a pretty significant cushion.
Yeah, gives them room to maneuver.
It does. And they've been actively managing their debt, remember, reduced it by over $700 million. They also state they're in full compliance with all their debt covenants. Those are the rules and conditions set by their lenders.
Good. What about spending? Capital expenditures.
They expect CapEx to be at or below $1.0 billion for the full fiscal year 2025. The focus there is on projects that improve profit, general maintenance, and expanding capacity where needed. They also projected their net interest expense, the cost of their debt, to be around $375 million for this fiscal year.
Okay. And looking ahead, crystal ball time.
Yeah.
What does the company actually anticipate for the rest of fiscal 2025? What are their projections?
Right, so they're forecasting sales to be up between 2% and 3% for the full year. Their total company adjusted operating income is projected to land somewhere between $2.1 billion and $2.3 billion. That's a pretty strong range considering everything.
Yeah, given the beef headwinds.
Exactly. Free cash flow is anticipated to be between $1.0 billion and $1.3 billion. And their adjusted effective tax rate, they expect that to be around 25%.
Okay.
Stepping back for a second, if we try to connect this to the bigger picture, the company's strategy really seems to hinge on leveraging what they call their multi-protein, multi-channel portfolio, using that diversity, and focusing heavily on operational excellence, that network optimization stuff we talked about, and also valuing up offerings, which I take to mean creating more high-value, maybe branded products.
Makes sense.
Yeah, basically trying to meet consumer demand, grow internationally where they can. That seems to be their stated approach for navigating these current market conditions and, delivering long-term value.
So, after all that, what does this deep dive really mean for you, the listener? We've unpacked Tyson Foods' latest report, and it reveals a lot, doesn't it? The complexities of navigating these shifting protein markets, tackling huge operational overhauls, managing this really substantial legal landscape. You've got the challenging cattle market hitting beef hard, leading to that big goodwill impairment. Then you've got the chicken segment doing really well, partly thanks to lower feed costs. And this big strategic push for efficiency through network optimization. It's clear this food giant is making some major moves to adapt and, well, endure in a pretty volatile environment.
It really highlights that even these massive established industry leaders face constant pressure, doesn't it? Pressure
Yeah.
from commodity markets, shifts in what consumers want, and these really significant systemic legal challenges. Which I think raises an important question for you to think about. How does a company like Tyson actually balance these things? The immediate demands of market swings, these huge legal costs, how do they balance that with their long-term goals like global growth and becoming more efficient? Especially when their mission is, we feed the world like family. How might all these different forces play out in their future performance?
Definitely something for you to chew on. We hope this deep dive has given you a valuable shortcut to being genuinely well-informed on a company that, well, truly impacts dinner tables all around the world.